Good afternoon, everybody. Thank you for joining us. So we are going to give just 1 or 2 more minutes to allow our other folks that have registered to, kind of take a quick break and join this informational session. So thank you for waiting, and we'll start in about 1 minute. Okay, so we'll start kicking it out. Good afternoon, everyone. Thank you for joining us today in this our first info session with our partner, Harvard University, the Employee Credit Union. So this partnership is part of the benefits initiative for the well-being at Boston Children's, which focus on health and the financial well-being programs. So that's why we have connected with this great credit union to be able to bring financial topics to our employees that focus on different areas of our financial life. And so we have started doing these webinars. Uh, we have been together for like about a year now, and we are providing quarterly webinars so that the employees can join. You can also share this with your family members, and they can also join these info sessions as well. So we are recording the session right now for those that are not able to join us. And after, when we get the recording ready, we will be sharing that with everyone that has registered and is not able to attend. You can feel free to forward that to any of your peers and also your family members who you think that might contribute with this. So the meaning of this session is, just take some tips from these folks that will be providing the presentation and see what can we get out of it. And then, connect with them if you feel that, you need more of a one-on-one coaching, which they will be talking about after. So my name is Wendy Mateo Arias, and I work in Human Resources, the Workforce Development Program, so representing here the HR. Thank you for joining again, and I'm going to pass it on to Jen.
Thank you, Wendy, and thank you everybody for joining us. We're happy you could make it. The topic of this webinar is going to be making the most of your tax refund. As Wendy said, my name is Jen Fries. I am the Community Engagement Manager for the Harvard University Employees Credit Union, and I'm joined by my colleague, Ty Robinson, who's one of our Community Engagement Specialists, and also by my colleague, Terrence Bazile, who is just joining us now as well. So we're excited to be here and happy to have a chat with you about this topic.
Good afternoon, everyone. Thank you for joining us. Thanks, Jen.
Yeah. So just a little bit about the credit union. You are, as an employee of Boston Children's Hospital, you and your family are eligible to join the credit union. And the credit union is a not-for-profit financial institution. We were founded by and are run by Harvard employees. And we are focused upon the needs of our members, and we're owned by our members. And that means that we're we have some more freedom to create products, services, and rates that are truly the best for our members. We don't have to account to any shareholders or make a profit for another person. So it's all about what's the best for our members, and we're really proud of that. And we would love to have you join us if you're not already a member. You can bank with us from anywhere in the country using online banking and also shared banking, shared branching with other credit unions. So you can walk in and do your banking in person from anywhere in the country if our particular branches are not convenient to you. So this topic is just one that we thought was timely at this time of year about sometimes people have a small amount of money or sometimes a large amount of money that they're getting in a refund from taxes. And just to set the stage, why are you getting a refund? I think, most of us know this, but just in case this is, if you're new in the workforce. So this is just an example. This person's being paid $80,000 a year. They get paid biweekly. And here where it's circled, you can see that they are having withheld federal income taxes of $411 per pay period. So that's 26 pay periods a year because it's biweekly. And that means that they are setting aside $10,686 to pay their taxes. If the amount that they owe the federal government is less than that, they will receive a refund. So the reason you're getting a refund is because you've set aside or already paid more than you owe for this year. The advice that I'm going to be giving today, though, is not just applicable to tax refunds. I'm actually going to be going over the topic from a little bit more of a 10,000-foot point of view, because this will cover what do you do if you get a small amount but meaningful amount of money. So that could be maybe you just got a pay raise or a COLA and you're trying to decide how to readjust your budget or what to do with it, what makes sense. Maybe you got a money gift for a special event, like you had a wedding or a bar mitzvah or something else, and you're trying to decide what to do with money that you got. Maybe somehow you've decreased your expenses. You paid off a car loan, and now suddenly you have money that's free in your budget, and you want to think about or make smart decisions with that. I remember when my child aged out, was when she first went to kindergarten, and I had been paying for full-time childcare up until then. It was like I got this huge raise. So maybe you have a new, just timing-wise, some new area where there's slack or freedom in your budget, and you want to make smart choices. So we're going to be talking about all those. So the tax refund is one chunk of money you could be getting, but it could be other chunks of money. So the first step in any of this is to think about yourself and your financial goals. So if you're somewhere where you have a piece of paper and a pen, I would say it's worth it to just kind of think for a minute about, and maybe you know this very well, or maybe not, but if you want to just write down what your financial goals are. So those could be as simple as that you want to reduce the stress of being in debt if you're in a situation where you feel like you're under a lot of stress. Maybe you're saving for a big event, like a wedding or a down payment on a home. Maybe you want to pay for higher education for yourself or for a family member. Maybe you want to buy a car in the future. Maybe you would like to return home and see family abroad, and that's a big expense. So there you could have any number of financial goals coming up. So take a minute and just think about what those are for you, or even write them down, because at the end we'll be talking about some questions that people might have. So how, if you have a small but meaningful amount of money, how should you use it to improve your financial position? Well, that all depends on where you're starting from. And so we're going to be going through some steps for financial wellness in recommended order. Now, that can help you determine how you would use a small amount of money, small but meaningful amount of money, um, and what the conventional wisdom is. But you're also going to have to think about your own goals that you just wrote down and your values when you think about how exactly you would want to apply this money. So we're going to go through first steps, intermediate steps, and advanced steps. So first steps. Very first thing we're going to be talking about is you need to be covering your monthly expenses. So if you're not doing that yet, obviously when you get your tax refund, it's going to be toward that. Then the next step for financial wellness is to build a small emergency fund. The next step after that is going to be maxing out your employer-sponsored matches. We're going to be talking about each of these in detail. Then you're going to be wanting to pay down higher interest debt. And then finally, you're going to go back to that emergency fund that you started at a small amount, and you're going to try and build it up to 3 to 6 months expenses. So let's break some of those down and talk about them. So again, this webinar assumes that you're covering your monthly bills. If you're not, your tax return really should go toward that. And this webinar will give you some ideas for the next time you get, when you get a pay raise. So right now, your focus is on covering your monthly bills, and then you can have for the future what the next thing is that you're going to do to kind of give you some financial wellness and freedom. So once you're covering your monthly bills, the next step is to think about starting an emergency fund. What is an emergency fund? It's just what it sounds like. It typically is money that you're not to touch at all. The idea is that you have it for a true emergency. But everybody has to start somewhere, and we recommend that you start thinking about an emergency fund that might be $1,000, or it might be 1 month's rent, which I realize for most of us is more than 1,000, or 1 month's mortgage, so that if you do not have that yet somewhere, then that would be your first step to financial wellness. And a great use of your tax return money, refund money, is to set that up so that you have that in your back pocket. Where do you keep that? You keep it somewhere where it is insured. It is a high yield savings account. You do not want there to be any risk associated with your emergency fund. So this is not your investment fund. At the credit union, we have a high yield savings account called Smart Reward Savings, but it can be any high yield savings account where you can get a decent amount of interest and also know that it's 100% safe. So you've done that. You have your 1 month's housing costs in an emergency fund. What's the next step? Okay. Now what you want to do is you want to be maxing out your employer match. What does that mean? Most employers will match a certain percentage of your salary if you contribute to your retirement. They will match it. And what that means is you're getting an 100% yield on that money. You put $1 into your retirement and your employer will match it dollar for dollar up to a certain amount. So you want to be putting that amount into your retirement and making sure that you're getting the maximum employee match. For most employees at Boston Children's Hospital, this is 1% of your salary. So you need to check with HR about whether this applies to you and your particular plan. So if you're making $50,000 a year and you're getting back $500 in your tax return, perfect. That's 1%. If you put that into your retirement, you're going to get that another 500 immediately matched. So that immediately, it might take a few weeks, but just that's a match, that's a guaranteed match. So you definitely want to be putting in that amount, but we don't recommend you do more yet. So then you've got to this stage of financial wellness, and that feels pretty good. What next? Do you have high interest debt? So often this is credit card, but it could be other kinds of debt. So now you're covering your bills. You've saved 1 month's mortgage or rent payment. You've contributed to get your full employer match. Now you're going to pay down any high interest debt you have. Definitions can vary, but let's say over 10%. If your interest rate is over 10%, let's think about paying that down more quickly. And a tax rebate refund is a great way to get a chunk toward, if you pay your minimum, you're never going to pay off that debt. The minimum payment per month is structured so that you will always be owing money. So when you have a chunk of money, if you can throw that at your debt, you can start to make some real headway. And there's sort of two methods for paying down debt that are common ways to conceptualize it. And I'm just going to talk about one now and one later. Either one can apply. The snowball method is best for people if you have a lot of debts and you're paying a lot of monthly bills and you're worried you're going to miss one, or you sometimes do miss a due date because you just have too many to keep track of. The snowball method can be great, and that's where you look at which is your smallest amount of debt and which one could you pay off feasibly the quickest. So say there's one credit card that you only, you owe $800 on, but you keep paying the minimum, you get your tax return and you just pay that off. And snowball is the idea that you start small and you keep building up. And here you can see the picture of the person who's rolled a giant snowball, but they probably started with something small. So that is the snowball method of paying off debts. And we'll talk about the avalanche method later. Okay, so now you have been working toward and you've paid off your high interest debts. So, or you don't have any. You come onto this webinar and you're like, oh, Jen, I have that. I don't have any high interest debt. That's great. So what next? Well, next you're going to want to build up your emergency fund. An emergency fund is sometimes known as an opportunity fund, freedom funds, or even FU funds, because it means that you can tell someone, you know what, I don't need this. I have the money that I can make choices for my own freedom. So if a job's not working out, or if a relationship isn't working out, or a landlord isn't working out, it allows you to have that freedom and flexibility. So you're going to work on building up your emergency fund to be 3 to 6 months of your expenses. And that's going to take a while for most of us. Tax rebates often not going to be enough to do that. But you could use your tax rebate as a way to kind of jumpstart that process. After you've jump-started it, you're going to want to automate contributions, and small amounts add up. So you can go into your direct deposit with your paycheck and talk to HR about putting a percentage or a dollar amount every pay period into your savings. And you just want to leave them there if at all possible. Because again, that's going to be an insured account, high yield savings, liquid. It could be, so liquid meaning usually for emergency fund, you don't want to put it in something like a CD where you cannot access it without penalties. So you want to have something that you can get to when you need it. If you had an emergency, if you had a layoff, if you had a medical emergency, if you had anything, you can get to that money. So again, the credit union has the smart reward savings, but it could be any high yield savings account that you went to. All right, you've done all those beginner steps. You're like, Jen, that's fine. I'm there. I got my emergency fund. What next? So some of the best uses of your money for these intermediate steps are going to be paying down your moderate interest debt. So you've already paid down high interest debts. You don't really have that anymore, but you still have some other debt that you're working on. You may want to start creating sinking funds or set-aside funds, and we'll talk about what those are. You might want to contribute to an IRA. You might want to increase your retirement savings significantly over whatever the employer match is. And again, we'll talk about each of these. Eventually, you're going to work up to the point where you're saving 15% of your income for your retirement. So moderate income interest debt. So we talked about the snowball where you pick your smallest debt, you pay that off, and it's partly psychological. You get the feeling like, okay, I'm done with that debtor. That's great. What is the avalanche method? The avalanche method is where you're choosing your highest interest debt and you pay that one first. So even if it's bigger, if it's whatever's the highest interest debt that you have, you start from there, and then the benefits roll downhill like an avalanche. So moderate interest debt might be defined as debt over 4.5%. It varies because basically you're saying debt that is higher than what you could get in a normal savings interest rate. That's going to be your moderate interest debt. You're probably not going to want to pay down debt that is a lower interest rate than what you could get in savings. You just take your time with that. I wouldn't bother. So if you still have like a student loan that's one of those 3% ones or something, just pay it at the regular rate. But if you have moderate interest debt over, say, 4.5%, excluding your mortgage, pick a method, snowball or avalanche, and start paying that off. So yeah. Now I want to talk about sinking funds. So sinking funds, you already have your 3 to 6 months in your emergency fund savings. You paid off your high interest debts. You paid off your moderate interest debts. What now? Now you're going to want to start thinking about creating sinking funds or set aside funds for any expenses that are not monthly that you can anticipate you are going to have. Those could be expenses like a down payment for car repairs or purchases. Eventually you're going to need to buy a new car. Instead of having to finance it later, start putting money into your car fund. You could have a vet fund or pet fund because maybe you have an elderly pet. You could be saving for a vacation, your Disney fund or whatever it may be. You could be saving for school fees if you know those are coming up for you, or for gifts or holidays. If you have a holiday that's coming up that is a big gift-giving occasion, then many institutions have like Christmas club savings or other holiday club savings. We do have something like that at the credit union. Now, I'll be honest, like some people really psychologically like to have this in a separate account. I know that's my vacation account, or I know it's my wedding account. Other people will just keep it in their emergency fund, but they know that anything over X dollars, everything over 6 months of expenses is for this purpose. So it just depends on you and how you like to structure things, but either way can work. And to some extent, it's knowing yourself and your own psychology. Are you more likely to dip into something if it's in one place versus the other? If so, you might want to make it so that you kind of remind yourself what your goals are and what your why is. What are you saving for? And this is sinking funds are some of the fun things financially. Okay, these are the things I want to do. I've got my needs covered. Now I can start to get into some of these wants. So now you've got your sinking funds, you've got your emergency fund, you've paid off high and moderate interest debt, and you're maxing out your employer match. Now you might want to think about starting an IRA. Each year there's a limit that you can put into an IRA, and you can have a goal that every year you're going to fully fund to the federal limit an IRA. And then you can increase your employer-based retirement savings. We recommend that your totals between IRA and employer, any retirement savings you have are around 15% of what you earn. And that will set you up in a good way. If you do that across your career or as much as you can, that's going to set you up for being able to retire and not worry in your retirement. So here's a little bit about the time value of money. So here's two people, Iris and Lucas. They each invest $100 a month, but when they start really matters. So Iris does $100 a month for 10 years between when she's 25 and 35. And her total invested is $12,000. And the future value when she retires, because of the time value of money that she started early, is going to be $200,000. Lucas didn't start until 35, but did that $100 every month for until he turned 65. So he is doing that same amount per month for 30 years. His total invested is going to end up being $36,000. That's what he puts in. And then with all of his earnings, his future value is $149,000. And that's because that money that you put in later doesn't have as much time to give you returns. So definitely start saving early, even if it's a small amount. It may seem like it's not much, but it really makes a difference. And then as far as IRA options, your options include a traditional 401k or IRA. These are typically pre-tax dollars. Often employer plans are pre-tax, but you can also have a traditional IRA that is pre-tax. You can set one up through the credit union. You can set one up lots of other ways too. And then the money is taxed when you withdraw the funds. And then the other option is a Roth IRA. That is when you're investing with post-tax dollars, so from your take-home pay. And when you take it out, it is withdrawn tax-free. You can set up a Roth IRA through the credit union or any number of other places that do investments. And it kind of depends on where you think you'll be in retirement. It's hard to predict for most of us, but if you think that when you retire, you're going to be very tight for funds versus when you retire, it seems likely that you'll have a little more freedom in your budget. So you can talk it over with at the credit union, you can talk it over with our investment person if you want to. And at other places, there's usually advisors to talk through your options. So you've done all of that. Say, oh, Jen, I'm in good shape. I have an IRA. I'm doing 15% retirement savings. I have emergency fund of 6 months. What are some of the other things? That's when people start to recommend that you save for your child's college. So the phrase that's often used is that your child can borrow for college, but you can't borrow for your retirement. So the conventional wisdom is definitely that save for your retirement first, and only when you're fully funding your retirement, then start to set aside for your child's college. However, I'll be honest with you, I reversed this for myself, and I was contributing to my retirement, but I did not max it out. I have one child and I saved for her college. That was my choice. So all of this is influenced by your values and what's important to you. However, the conventional wisdom I will definitely say is that save for your retirement first, then save for your child's college. Then you can start to utilize or max out health savings accounts. So if you have access to a health savings account, that's another pre-tax vehicle that can allow you to set aside money for future healthcare expenses. And that can be valuable for if, most of us are going to have more healthcare expenses later in life, so you can have that money set aside. You can max out fully the allowable retirement contributions. You can even look at things like backdoor Roth IRAs and that kind of thing. We're not going to cover all the ins and outs of that in this. So save for your child's college. We talked about this. The typical way that is advised to save for college is a 529 plan. Your child will be named as a beneficiary, but you can change the beneficiary on a 529. That's a way for your money to grow tax-free until the time comes for them to go to college and you start withdrawing. There's also Coverdale plans and other plans that are available to save for college. We talked about health savings accounts. If you have access to one of those, that can be another way to set aside money to have it grow tax-free. So the government has set up some incentives for health savings accounts. You're going to want to start, again, maxing out your retirement contributions. So the maximum allowable per year under your 401k, 403b, IRA. So if you're in great financial shape and you've done all the other things we've said so far, that's definitely so you can do more than 15%. You can max out whatever is available. And you can go on to something like nerdwallet.com. There's many retirement calculators available. I like the NerdWallet one. There's also one through AARP, the American Association of Retired People. Lots of other, I mean, pretty much any investment company is going to have a retirement calculator on there. So you can see, you know, where you stand and what that looks like for what you'll have saved in the future. Say you want some more individual advice. Oh, this slide needs to be updated, sorry. COVID-19 counseling is not really something that is being done anymore, but through the credit union, we do have a partnership with a nonprofit called Green Path. And Green Path Financial Wellness offers a variety of free individual counseling around financial issues. And this is the thing that Wendy was alluding to earlier, that if you want to get into depth about your own financial situation with somebody, if you're facing credit or debt issues, if you want personal budget advice, if you want housing financial counseling, all of those are available through Green Path for free for our members. And then we also have a service that's available for a small fee of $75. If after going through debt counseling, you decide you want it, there's a thing called debt management plans. So if you're feeling overwhelmed by your debts, you're not alone. Green Path can help. You're going to go to huecu.org/greenpath. So that's a page on our site. If you go through that site, then you will be eligible for the free counseling because you'll be referred by the credit union. You don't have to be a member of the credit union to go through the site. You can be referred for that free financial wellness counseling just by going to that site and clicking through. So that is available to you. Please take advantage of it. If you or your family are facing any financial difficulties, you're not alone. Lots of us have gone through it and you can get help that you need. This is a really important disclaimer for this. None of this should be construed as tax, legal, or investment advice. You're going to have to make your own choices based on your particular situation, your own values. You should be consulting with tax, legal, or investment advisors, experts, and you can also tap into Green Path for free financial counseling as well. So this is kind of a general overview. Again, that 10,000 foot, like this is conventional wisdom about how you should use your money. How does that translate to your own life and what you're feeling about your finances right now? We would love to hear from you. This is the end of our slideshow, so I'm going to unshare the screen and just allow people, if there are any questions, you can go ahead and put them into the chat, or if you prefer to come on camera and come off mute and ask questions. Maybe you could raise hands if you want to do that. I think we allow hand raising. So we'll give it a minute for folks if they want to ask questions. And if we don't see any, then we'll thank you for your time. But go ahead and put into the chat if you're having some questions based on what we've been talking about already.
Okay, and Stephanie asked how you will get the recordings